So today we shall talk about financial needs for small and medium enterprises. So financial needs are very, very critical in any organization because they help the organization to realize the objective in business. Because with financial needs, you'll be able to sort out many issues that might affect the organization at large. So when we talk about finances, basically what comes into our mind is the analysis where we want to establish whether the business is able to support itself, whether the business is liquid and it is able to pay the employees and at the same time is able to pay the suppliers or various stakeholders who support the business in one way or another. So before we start, we have other issues that are very critical or various terms that are used in finance. The first term is an accounting. And accounting is the process of recording business, the financial transaction. Then the process includes analysis of or summarizing and reporting business. So we are trying to record all the transactions that come into the organization. And all the transactions sometimes are normally documented. So those documents are the ones we analyze and we try to summarize and come up with financial statements that support the business enterprise. Then we have accounting entries. This is the formal recording of all transactions in the books of accounts of the organization. When you look at the books of accounts of the organization, we have the books of original entry and other books of accounts. So the accounting entry is that process of recording all those transactions in business. Then we have accounting period. This is the duration of time when accounting functions are performed. For example, in most organizations, the accounting period is the financial period, which goes for 1 year and normally starts in the month of July, 1st July up to 30th June. Then you have assets. Asset is something that contains the economic value. And remember, in organizations, we have fixed assets and we have the non-current assets or the current assets. So fixed assets are assets that are of high value. For example, when you talk about land, land is a fixed asset. When you talk about building, when you talk about machines and equipment, those form part of non-current assets. Then you have current assets, and current assets are the assets which help in operationalization of business. For example, when you talk about inventory, inventory is a current asset or an unfixed asset. When we talk about debtors, for example, these are form of non-current assets. When we talk about prepayments and other forms of non-current asset. Then we have budgets. A budget is an estimation of revenue and expense over a given period of time. For organizations to survive, they have to set aside a budget. And this budget helps them to be able to realize that indeed we have money to spend. So it creates what is called financial estimate. What you want to use maybe at the end of every financial year. How much you must use as an organization so that you don't go bankrupt. Then we are also talking about capital expenditure. This is money spent on buying or improving physical assets. So when you talk about capital expenditure, we have two forms of expenditure. We have capital expenditure and we have operational expenditure. So capital expenditure is when you buy assets. Assets that are of high value, then we are saying the organization is spending capital expenditure. Then we have operational expenditure. These are normal expenditure that help in the day-to-day running of the organization. Then you have cost of goods, where we have direct costs incurred by a business in the production of goods. So remember, every day organizations spend a lot of money for purposes of production or for purposes of operation of business. All that is referred to as the cost of goods. Then we have creditors. This is an entity that gives permission to others to borrow money and refund at future dates. Most creditors are banks who support business by offering financial help for all businesses. So at the end of the day, you agree with various creditors to finance your business and you will pay at a later date. Then we have current assets, which I talked about. These are the company's assets are expected to be sold or used within a period of 1 year. So remember I said current assets are assets that are short-term assets. They normally go for maybe a year. But the other ones I said fixed assets. These are assets that are long-term in nature. Then you have current liabilities. These are obligations payable within 1 year. So remember in liabilities, this is the amount that you have to pay as an organization, the amount that you owe other businesses. Therefore, you have to pay within a certain period. And normally, it's a period of 1 year. Then we have debtors, an entity or a person that owes money to the business. Remember, we said debtors form part of the current assets because this is money that other businesses or your business. So they have to pay. And once they pay that money, then it means that money is yours. Then we have expenses. Expenses is the cost of operation a company incurs to generate revenue. So sometimes you have to generate revenue. And for you to generate revenue, you have to spend money to make money. So the money that you spend is what we are referring to as the expense. Then we have financial ratios. In order to understand whether a business is doing good or doing bad, some accountants normally do what is called financial ratios. And these are metrics for measuring the performance of the business against other parameters that are very critical. So for you to understand whether a business is doing good or bad, you have to do what is called financial analysis. Then you have financial statements. These are written reports that summarizes the financial position of a business in a given period. Remember, it is always advisable for companies who are operating in the public space. Every year you must publish your books of accounts so that the public is able to know the progress of that company. The essence of that is to ensure that at the end of the day, the investors who have invested in that business are able to see what the business is doing so that they can make other financial decisions that will either support the business or will not support the business. So we have different financial statements that are normally published in the books of accounts. And one of the statements is the statement of financial position. And the statement of financial position, we are saying, this is another name for the balance sheet. A company must provide a balance sheet at the end of the year. And the balance sheet basically summarizes the assets together with the liabilities, and we are able to know the capital that you hold in the organization. Then we have another statement which is called the statement of comprehensive income. This is a statement that helps you to understand whether a company is making profits or losses at the end of the day. So these statements are very critical because it will help even the organization to make decisions, whether to continue experiencing maybe expenses. Maybe they can decide to reduce some expenses, or they can decide to increase some current assets for purposes of running the business. Then we also have financial cash flows. And financial cash flows, we are talking about both cash flows that are inflows and cash flows that come into the organization and the cash flow that go outside the organization. Then the other thing we are talking about is inventories. And inventory here, we are talking about a a form of working capital that helps to support the business. And inventory, in simple terms, is the stock that is held by the organization. And this stock can either be stock in raw form or stock in work in progress or store in finished goods. Or sometimes it can be stock that is going to be used for material, operation, and maintenance, which is very, very important. Liabilities, these are debts owed to the creditors. So the money that you owe the creditor is referred to as a liability, because that is something that you have to pay, regardless of whether the business is doing good or bad. Then you have the owner's equity. This is the owner's investment in an asset after all liabilities have been deducted. So this is the money that now you remain with after you've paid all your liabilities to the creditors. Then the profit is referred to as the difference between the amount earned and the amount spent. So this is the difference between the revenue and the liabilities that you have spent at the end of the day, or the expenses. So once you do that, then you'll be able to remain with the profits. And profits can be in two ways. We have the gross profit and we have the net profit. Then we have revenue. Revenue is income earned by the business from the sales of products or services offered. So once you sell products or services, you generate what is called revenue. And this is revenue that is referred to as the income that is earned by the business. Then you have the retained earnings. Sometimes once you make profits, you can decide to retain some money to the business. That money is what you are referring to as the retained profits. The amount of net income available after the business has paid out dividend to its shareholders. For public companies, they normally have shareholders, and shareholders are owners of the business. And shareholders can be in two groups. We have the ordinary shareholders and we have the preference shareholders. So the ordinary shareholders are the ones who form the mantle of the company. They are the ones who make critical decisions of the day-to-day running of the business. Preferred shareholders are also very critical because they buy shares of the company. And once you buy shares of the company, you are also part of that company in profits and in losses. Working capital. This is the sum of cash and highly liquid investment a business has to pay for the day-to-day operations. So we have businesses that have to survive as a result of the working capital. So working capital helps you to be able to operationalize your business on a day-to-day basis. So once you understand that, you need to understand the various financial analysis of financial statements. So we have different ratios, and the first ratio we have is the liquidity ratio. Liquidity ratio is a ratio that shows the ability to convert assets to cash or acquire cash through a loan or a bank money to pay its short-term obligation and liability. So for a business to survive, they normally look at the liquidity of that business, the flows, the money that is flowing for that business, so that at the end of the day, the company is able to know whether they are doing good or bad. So liquidity refers to a company's ability to pay its short-term debt, and it is determined by the liquidity ratio, which defines the measure of the ability of a company to pay off its short-term liability. So liquidity ratio will help us to understand whether a company is doing good by ensuring that they are able to pay their short-term debts or their short-term liabilities. So the current liabilities and the liquid asset determine the liquidity ratio of a company. And different ratios can be in this category, where we have the current ratio. And when you are calculating the current ratio, what you normally do is you take the current asset, divide by the current liability. The other ratio that is very critical is the quick ratio. And when you're calculating the quick ratio, you're calculating the assets, the quick assets, and the current liabilities.
Just a question.
Yes.
What's the difference between a quick asset and a current asset?
A current asset is an asset that you are going to pay within a year. But for quick assets, these are assets that maybe are used within a month or something like that. But I'm not sure. Maybe we can check. Just a minute. Just a minute. Then we have net working capital ratio. It is used to determine the liquidity of the available assets. And we are saying an increase in net working capital or net working ratio indicates an increase in the investment in liquid assets than in fixed assets. So when you see an increase in working capital, remember we said working capital basically forms the current assets. So when you see an increase in current assets, then it means we have an increase in liquid assets vis-a-vis the fixed assets. And when you are calculating the net working ratio, you are calculating the current assets minus the current liability divided by the total assets. Then we have the cash ratio. Cash ratio is calculated by dividing the cash with the current liabilities. Then we have cash coverage ratio. This determines how likely the business can pay interest on its debt. And this is calculated by earning before interest and taxes plus the depreciation divided by the interest. Then we have operating cash flow ratios. This is calculated by cash flow ratio, which is equals to operating cash flow and current liability. So most of these ratios are very critical when you are doing financial accounting. And maybe if you have interacted with financial accounting, you must have had some of these ratios. And this is a very common unit in financial accounting. Then we have the gearing ratio. Gearing ratio refers to the amount of debt related to equity capital that a company uses to fund its operation. So gearing ratio will help you to understand the equity that is needed to fund the business operation. A high gearing ratio translates to a high debt to equity ratio, which increases the risk of financial failure. So we have different types of gearing ratio. The first one is debt to equity ratio. And when we are talking about debt to equity ratio, it helps us to calculate the weight of total debt and the financial liability against the shareholders' total equity. It also helps to determine how a business capital structure is focused, either towards debt financing or equity financing. And maybe debt financing is the finances that are used to pay the debt that the business owes. But equity financing is financing towards getting equity or getting money that will support your business in form of equity. Then when you're calculating the debt to equity ratio, you are taking the total debt divided by the shareholders' equity. Then we also have the other one, which is called the equity ratio. Equity ratio determines how financed business assets are by shareholders' investment, and a higher percentage is preferred. So you are able to understand what you have in form of the total equity, and you also divide it with the total asset, and this will help you to get the equity ratio. Then we also have the capitalization ratio, and this ratio compares the total debt to the total capitalization, and it helps to determine the extent to which a business is operating on its own. And when you are calculating this ratio, or the capitalization ratio. You take the long-term debt, divide by the long-term debt. The long-term thing is confused. You take the long-term minus short-term debt. You divide by the long-term minus the short-term debt plus the shareholders' equity. Then you'll be able to know how much you have in terms of capital for the business. Then we have the debt service ratio. This measures the ability of the business to use its operational income to repay its debt obligation, including the interest on both short-term and long-term debts. Then when you're calculating the debt service ratio, you are taking the equity. I'm not an expert in finance, so I'm wondering what is
I can help
DTI?
you. EBITDA is earnings before interest, tax, depreciation, and what? Yes.
Amortization.
Yes.
Okay. Well, I'm
Then
an
you
expert
divide
in
by.
supply chains, but not in finance. So
I had done
sometimes
I did a little bit of accounting.
accounting, your specialization is in accounting
No. I just did CPAs all the way to section 4.
or CPA.
Sometime back, yeah, immediately after high
Okay.
school.
CPA. So importance of liquidity ratio determines the ability to cover short-term obligation. So it helps the company to know whether they'll be able to cover short-term obligations, maybe from the creditors or maybe from some investors, short-term investors. Number two is that it determines the credit worthiness of the organization, whether the organization is able to pay its creditors at the time that is required. So creditors analyze liquidity ratio when deciding whether they should extend a company's credit. Remember, companies always enter into contracts with various creditors, and they agree with the various creditors that they are going to pay their money maybe for a period of 30 days, 60 days, or sometimes it can go up to 90 days. So when a creditor wants to establish whether the company is able to pay, they will do what is called liquidity ratio. Then the other thing is it determines the investment worthiness of the organization. Therefore, if an organization wants to understand whether they are doing good or bad, then they will always perform what is called the liquidity ratio to ascertain that fact. Then the other thing we are going to talk about is financial plans for the business. It is very important to plan for your finances. And that is why we have the whole issue of a budget in organization. And budgets normally give us a framework on how we are going to spend the money within the organization. So financial planning is the process that enables a business to make decisions about money that facilitates the sustainability of the business. So business plans or financial plan will help you to be able to plan for your money so that you know exactly how you are going to use your money or the decision about the money that you are going to spend. And this decision will help your business to be able to be sustainable in the unknown future. And the main reason why companies are operating is to be able to be sustainable or sustainability in their business for a very long time. It is also defined as the process of determining the capital requirements in a business and initiating financial policies in relation to investment, procurement, administration, and finances in a business setup. So financial plans or financial planning will help you to be able to determine how much you need for your business to run, how much you need to invest for your business to be operational. It also helps you to initiate some of the various policies that will support your business, both in the short run and in the long run. So financial planning is the process that enables businesses to make decisions related to money. So you'll be able to make decisions related to money. And remember, if you don't make such decisions, then it means your company will end up becoming bankrupt and you might end up closing as a result of that. So you have to plan for your business on a day-to-day basis. So we have those decisions that are short-term in nature for operational purposes, but we are also having decisions that are long-term. Where a company wants to buy an asset, they'll always make a decision and plan for that decision in advance so that they do not affect their finances. So the objective of financial planning is to determine the capital requirement for the business and also the capital structure for that business. It enables the framing of financial policies and ensures financial resources are utilized maximally in the best possible manner. So you'll be able to utilize the financial resource, because if you don't do that, then you'll end up wasting a lot of money, and this might jeopardize the business transactions or business operations. So what are the benefits of financial planning? What are the benefits of financial planning? One of the benefits is that it ensures the business has sufficient funds for normal operation. So you'll be able to understand how much you have, how much are you setting aside for business operation on a day-to-day basis, and how much are you going to sacrifice in long-term investment. So once you know that, then it becomes easy for you to be able to operate the business. Then the other one is facilitate the growth and expansion of business to ensure the future is future survival of the business. So you'll be able to understand how much money are you going to bring back to your business for purposes of growing your business and for purposes of expanding your business. So it's very, very critical at the end of the day, because it will help you to know that. Then the other thing is maintains the stability of a business by ensuring there is a balance between cash inflows and cash outflows. So it will help you to stabilize your business by knowing how much you bring into your business and how much you're spending outside the business. Then the other thing is it enables the business to be financially stable and reduces uncertainty related to finances. So you'll be able to understand the business, your business inside out, so that your business will be sustainable. And remember, these plans help you to understand the uncertainty related to finances. So in the event something happens that you did not plan for, you'll be able to have a contingency plan for that thing. Then the stability of the business is determined by the ability to manage the available finance effectively. So once you plan well, then it means you'll be able to have a strategy that will help you to manage your business effectively. It will also help you to have various issues, various financial risks leading to loss and bankruptcy. So what are some of the financial planning tools? One of the tools is the income statement. And an income statement is a summary of income and expenses incurred by the business for a certain period of time. And it helps you to understand what you are going to incur in form of costs and the earnings for the business. So when you look at the income statement, we have an example there where we are looking at the revenues. We are looking at the, just a minute. We are looking at the revenues. And revenues here, we are saying we have the sales, less cost of goods sold. Then you get the gross profit. Then you less your expenses. And the expenses here can be salaries, storage, rent, maintenance, insurance, depreciation, other expenses. Then you get the total expense. Then you, after you less the sales together with the expenses, you get the net income before taxes. Net income before taxes. Then you have income tax expense. And then after you less, you get the net income. So that is a summary of the income statement. Then you have a balance sheet, and we say the balance sheet is also referred to as the books, the statement of financial position. And a balance sheet is a summary of the financial position of a business at a particular date. And it includes the assets, both current and long-term assets, the liabilities, both current and long-term liabilities, and we have the owner's equity. And for the balance sheet to be ideal, you must include those details. That is a summary of a balance sheet. And this is a balance sheet for company XYZ. And remember, when you are calculating the balance sheet, you must have a title of your balance sheet and also the period in which you are calculating your balance sheet. So the balance sheet has the asset, where we have the current assets and the non-current asset. And the current asset, remember, form part of the working capital, where we have the cash, we have accounts receivable, we have the inventory. Then non-current asset, we have equipment, we have land and building, we have investment property, and we have accounts receivable or cash flow statement. We have cash flow statement. Then total assets. Then we look at liabilities, current and non-current liabilities. For current liabilities, we have the accounts payable, transfer payable, employee benefits. Then the other ones, we have borrowing due after 1 year. Then we have the net assets, where we get the fixed, the capital, meaning the assets minus the liability. Then you get the net asset. Then you also have the cash flow statement. Cash flow statement. Remember, we are saying cash is very essential in the life of a business because it helps you to make very critical payments to suppliers. You also pay your salaries, and you also pay the dividend that you owe to your shareholders. Therefore, it is important to calculate the cash flow statement for the business so that you know exactly what you have in form of cash. Cash flow refers to the inflows and outflows of cash and cash equivalent. And when you are talking about cash equivalents, these are short-term cash investments that can be easily converted into cash or a known amount of cash. Therefore, when you are calculating the cash flow statement, we have very many important categories of cash inflows and cash outflow. The first one is the operating activities. And these are activities that are done on a day-to-day basis for purposes of ensuring that the business is up and running. And remember, operating activities are revenues generating activities of the business. What you do on a day-to-day for the business. Then you have investing activities. Investing activities, these are activities that are normally carried out when a company wants to invest on some fixed assets or some assets for the business. Therefore, acquisition and disposal of long-term assets and other investments form part of the investment activity. Then we have financial activities. These are activities resulting in charge of the composition and the size of owners capital and borrowing of the business. So these are financial activities that help us to understand the cash inflows. So when you're calculating the cash flow statement, we have the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. Once you get that, you get the net increase or decrease in cash flow and cash equivalent. You add the cash and cash equivalent at the beginning, then you get cash and cash equivalent at the end. Commercial break kidogo. So the other thing we will talk about today is assessing small, medium enterprise financial needs. So you need to do some assessment, because remember, assessment will help you to understand whether you have what it takes as a business to survive in the economy. And remember, when we are talking about economy, the economy has been dynamic for the past few years. So for businesses to survive, they need to do an assessment of their financial needs, whether they have what it takes in form of money, in form of the investments that they have, whether they can support their business in any way. And one of the reasons we do an assessment is to be able to check the performance of the business over a certain period of time. Remember, small, medium enterprises have little access to capital when it comes to loans from banks because of the size of those organizations. And some banks become so reluctant when they are giving money to some of these small firms. Therefore, before a bank can give you money, it is always important for the bank to do some analysis or assessment of your business performance. Whether in the event they give you this money, are you going to pay the money in a certain period of time? Therefore, the analysis for them is very critical. And assessment looks at both the operational part and the financial part. Therefore, we are saying bank loans are small, medium, most common source of finances. So business must continue. And for business to continue, in one way or another, the small, medium enterprises normally borrow to ensure their business is operational. And remember, even the big organizations, they have to borrow for purposes of surviving their business in the long term. And we are saying borrowing is not bad, but you have to put it in good use. What you borrow must be in good use. Then you have challenges for small, medium enterprises. So what are some of the challenges that these organizations face in their day-to-day operation of their businesses? Number one is lack of understanding of the needs of small and medium enterprise by financial institutions. Some of these banks do not understand the financial needs of small, medium enterprises, and this might affect their whole issue of operation. And this might also lead to some kind of unsatisfied business relationship. Then we have bureaucracy in accessing finances. You find that when they are going to access finances in this big organization, sometimes you have a lot of bureaucracy, a lot of processes that are unnecessary. And this might lead to wasting of time and might end up even not achieving your goal as a business. So these bureaucracies are very, very bad for the business. Then we have unjustified clauses. We have different clauses within the contract that are not even clear. When you want to take money from the financial institution, some hidden clauses that are not normally communicated at the right time. So you end up getting this information later after you sunk into the financial institutions. Therefore, this might affect the business or the small medium enterprises. Then you have poor relationship with customer with less room for contract negotiation. These big banks do not give room for negotiation with the small institutions. Then banks and other financial institutions find it challenging to evaluate small, medium enterprises. Remember, we have a lot of small, medium enterprises, and these might, they have different needs. So it might become very difficult for financial institutions to assess their needs because different organizations have different ways of operating their business. They have different forms of collateral that can be used in the event they want money. Then we have, due to the lack of connection with capital markets, most small medium enterprises cannot access finances since the institutions cannot monitor their financial status. So because of the size of these institutions, they cannot sometimes go to the capital markets to do their business. Therefore, they might not be lucky when it comes to issues of finances. So what are the potential risks and assumptions for financial needs? Financial risks are a threat to business as they disrupt the normal operation. And these risks might be identified, analyzed, and managed. Every organization, in one way or another, they face financial risks. And one of the reasons is that you cannot trust people. You cannot trust some employees with money, or some businesses might not be trusted. And this might pose a risk to the business. What are some of the financial risks that might be included? We have the market risk. And the market risk, we are looking at the forces of demand and supply. And this might affect the business in one way or another. Sometimes you have the demand, but we do not have the supply. And this might affect the business operation. Or sometimes you have the supply, but people don't have money to spend. And if that is the case, it becomes very difficult for the business to survive. Then we have credit risks. These risks result from borrowers' failure to meet contractual obligation. Sometimes you have borrowed money, but you end up not paying the money. And this might pose a risk to the organization. And if the organization has a lot of non-claimed finances, then it might end up closing because it will not have money to support their day-to-day business. Then we have liquidity risks. Liquidity risks occurs due to a business being unable to fulfill its commitment due to poor cash flow management. So you'll not be able to manage your finances because of the cash flows issues. Then you have operational risks. These are risks that are incurred by the business on a day-to-day operation, and this might affect the business. For example, we can talk about machine breakdown. This can affect the business operation. Employee problems can also affect the business. Then we have financial risk management strategies. How can we then manage some of these risks that happen in the organization? Number one is to accept as a normal operating risk. So number one is to accept the risks as part of the day-to-day business operation. The second issue or strategy is risk sharing. You can decide to share the risks, maybe by entering into joint ventures or futures and swaps or forwards. Maybe you can tell me what is futures or forwards.
I know it's something to deal with forex exchange. It's just that I can't remember the exacts.
Or the forwards.
Yeah, and even the swaps.
Or the swaps, huh?
Yeah.
Okay, then we have risk transfer. You can decide to transfer the risk to another organization or a third party for that matter. What are some of the financial assumptions? We have the accrual assumption. We have the financial assumptions. Financial assumptions refers to guides for financial planning for the business. And this includes financial forecasts on revenue, cost, and return on investments. Some of the assumptions may include the accrual assumption. Those ones are common in accounting. We have the consistency assumptions, conservatism assumptions, the going concern, economic entity assumption, and reliability assumptions. Those ones you can read.
Yes.
You can continue with that. Oh, and